Hello there. Thanks for joining me for the accounting and finance coaching session. My name is Echela Okwori. I'm your accountant and finance coach. Today, I want us to continue our series of looking at how to analyze financial statements. Today, I want us to look at profitability ratios. Profitability ratios. Don't forget, the last time we looked at another class of ratios, and we call them liquidity ratios. Now, liquidity ratios, I told you there are three. We did actually three types under that category. We looked at the current ratio, which we said is the current assets divided by the current liabilities. We also looked at another type, which we said is the asset test ratio, which we also say could be called the quick ratio. And we said is also the current assets, but this time around, less inventory divided by current liabilities. Then we looked at the third type, which we said is the cash ratio, and we said it has to do with the cash plus the cash equivalents, those assets that can be readily converted to cash under 3 months. We said cash plus cash equivalent divided by current liabilities. Now today I want us to look at another class of financial ratios, and these ones are called profitability ratios. And we're going to look at 5 of them. We're going to look at 5. The first one is going to be the gross. We're going to look at the gross margin ratio. We're also going to look at the operating margin ratio. We're going to look at the net profit margin ratio. We're going to look at the return on assets ratio, and we're going to look at the last one, the return on equity ratio. Now, these are the 5 I want to introduce you to today, and these fall under the category of profitability ratios. Now, generally, when we say profitability ratios, what do we mean? Profitability ratios are simply those ratios that we use in evaluating the ability of a company to make profit given its revenue, using its asset, and using equity. Okay? The ability of a company to want to see the ability of the company to make profit from the revenue it has, from the assets it has, and from the equity that it has. So without wasting your time, don't forget, we said all of this information can be gotten from 5 places. We said the first one is the statement of profit or loss and other comprehensive income, which we said is also called the income statement. That's one place to get most of the information you need. The second place to get your information from, we said the next statement is statement of financial position, which some people also call the balance sheet. The third one is the statement of cash flows. The fourth one is the statement of changes in equity. And the fifth one is the notes to the account. And I continue to stress that never ever underestimate what you can get, the information you can get from the notes to the account. Good. Now let's start quickly from the gross profit. That's the gross margin ratio. The gross margin ratio is simply gross profit all over the revenue multiplied by 100. So this is expressed as a percentage. Now, when we say gross profit, where do you get your gross profit from? The essence of this class is to guide you, okay? Is to guide you so you have a rock solid knowledge so that you are confident in doing your analysis. Now, where do you get your gross profit from? Everybody knows that gross profit is what we get from the trading account. Now, usually in the income statement, these 5 statements that I mentioned usually begins with what we say revenue less cost of sales. You get gross profit, okay? Revenue less cost of sales, and then you have your gross profit. Of course, the cost of sales is usually, we say, opening inventory, add purchases, less closing, and we get what we call the cost of sales. And of course, all the other adjustments. So where do you go to get your gross profit? you simply go to one of those 5 statements I mentioned, which is called the statement of profit or loss and other comprehensive income. In other words, you go straight to the income statement and you will get your gross profit. You will usually see it as a line item. Go and pick the line item, gross profit, and then you also go to your revenue. Where do you get revenue? Is it from the statement of financial position? No. Is it from the statement of cash flows? No. Is it from the statement of changes in equity? No. Is it from the notes? Of course not. You get it from the income statement, just like the gross profit. So if you get your gross profit from the income statement, also go to the first item in the income statement. It begins with revenue, always. So you get your revenue as a line item. Analyzing financial statements, they are not so difficult. So you get the line item called revenue. If you take the gross profit, you divide it by revenue, and you multiply by 100, it will come out as a percentage, and that is your answer. So if you are doing comparison, if you have 5 companies, you could be comparing, okay, company A is 60%, B is 70%, C is 40%, the 5th one is 10%. This is how you analyze inter-companies. You could also be analyzing, comparing between the different years for one single company. So you could say year 5 is this, year 4 is this, year 3 is this, year 2 is this, year 1 is this, and all of that. This is how you do your analysis. So the higher the percentage, the better for you. It means that the cost of sale is not so high. If the cost of your sales are high, then you need to do something about it. You need to minimize your costs in that area. But if you have a high percentage of the gross margin ratio, it is a good sign. So the higher, the better. Now that is for gross profit or gross margin ratio. Now let's look at the second one. The second one I want us to look at is the operating margin ratio. This is equal to operating income all over revenue multiplied by 100. Now, you will ask me also, where do we get this? The first place also, or the place to go to also, is the income statement. Now, after you say revenue, less cost of sales, you will have what we call gross profit. After gross profit, you now begin to talk about your admin expenses, distribution costs, other income to be added, and all of that. Now, at that point, which if you remember, I urge you to go back and watch. I'll talk about IAS 1 and IFRS 18. So if you go and look at that, remember we presented the format for you. So if you look at that lecture, just go back and watch it. It will help you a lot. But basically, after the cost of sales, you have what we call the gross profit. After gross profit, you have all of those overheads. So there, before you go to taxation, before you go to finance costs and all of that, there you have what we call operations. That is the operation segment. So that will give you the operating income. So the income you have from there, when you have gross profit plus other income and then less expenses, operating expenses, you will have what we call the operating income. At this point, you get the operating income figure, and then you divide it by revenue and multiply by 100. The higher you have, the better for you still. Now, the third one I want us to look at is the net profit. The net profit margin ratio. Now, the formula for the net profit margin is simply your net profit. Some will say net income all over revenue multiplied by 100. Now, what is your net income? Your net income is simply the profit for the year. The profit for the year. So for the net profit margin, we look at the after-tax net profit for the year. So the net profit for the year is what you get from the income statement. You get it from the income statement. That is the profit that the firm that the company made for the year, the profit for the year. So if you have all of that, you remove all the deductibles after your gross profit, you add your other income. If you have finance costs, it's deductible. You remove your distribution, you remove your admin, and all the other costs that are deductible. You have other administrative expenses. You remove all of them, and then you go to your tax, you remove your taxation, then you have what we call the profit for the year. Now, if you pick up the income statement, this profit for the year is usually very, very clear. In some companies, they make it bold for you to see. So it is not something that you go and calculate. It is something you pick as a line item. So when you pick your net profit for the year, you divide it by the revenue and you multiply it by 100, you have what we call the net profit margin ratio. Easy peasy. The higher it is, the better. If you have a very high net profit margin, what it means is that your tax planning is great. It means the company does a lot of tax planning, and it means that they have been able to control cost and they are making maximum use of their revenue to make profit. That is what it means. Now, the return on assets ratio is quite popular. It is the net income is equal to the net income before tax all over total assets. Multiply by 100. So if you look at the net income before tax, you divide it by the total assets, you multiply it by 100, you get the percentage. Now, where do you get this net income from? The net income is, as I explained before, you have the revenue. From revenue, you reduce costs of sales. You have what we call the gross profit. From there, you go to distribution, you go to admin. If you have other income, you add it to it. Of course, then you have other expenses, you deduct them. When you deduct other expenses, when you deduct admin, when you deduct distribution cost, when you add other income, what you have is what we call operating income before you go to finance costs and finance income. Good. At this point, you are looking at operations. This is where the operations is. But basically, you can always see operating income as a line item. But where you don't see it, I explained to you, after your gross profit, you have other income to be added. Then you have distribution costs. Then you have admin expenses. Then you have other expenses which are deducted. So other income is added. Distribution and admin and other expenses are deducted. That will give you what we call that will give us what we call operating income. Good. Now here we are looking at net income before tax. So when you go to the profit, before you see the area where we have the profit for the year, before that, you will see the tax expense. Before you see the tax expense, you will see a figure before the tax expense. Now that is the net income before tax. That is the net profit before tax. That is the best to use if you want to, because the essence of this return on assets ratio is to look at how the company is able to efficiently utilize its assets. So the best one for you, some people may allow net income after tax. That's the profit for the year. It is also allowed, but the best out of the two, or the better of the two, is the net income before tax, because it shows asset utilization better. So I advise you to take the net income before tax. And in the case of an examination, you can use either of the two, but state clearly why you are using the one that you are using. Both of them are also allowed. So if you also want to get your total assets, where do you get total assets? Total assets can be found in the statement of financial position, aka balance sheet. You find it there. So you have the current assets and you also have the non-current assets. And then when you total the two, you have what we call the total assets. So this total asset is what you are going to divide by. So when you take net income before tax, you divide it by total assets, you multiply by 100, you will get a percentage. And the higher I said, the better for you, because it shows that this company is able to make profit by using efficiently its assets. That's what it means. Now, the last one I want us to look at is the ROE, that is the return on equity ratio. Good. Now this is equal to net income. This one is not before tax, after tax. All over shareholders' equity. Good. Now, where do you get this? This is the profit for the year. You get this from the income statement. Easy peasy. You will always see it as a line item in the income statement. So go there, pull it out. It's the net income after tax. That's the profit for the year. Immediately you have it, you divide it by shareholders' equity. Now, where do you get shareholders' equity? You get shareholders' equity from the statement of financial position. Now, let's even break it down. What do we mean by shareholders' equity? Shareholders' equity has to do with ordinary share capital plus reserves of all types, whether they are accumulated reserve, any type of reserve. Once it's a reserve, it is meant for the ordinary shareholders. That's the owners. And then plus what? Surpluses. So these three is what makes up what we call equity. This is what makes up equity. So now, the formula for getting shareholders' equity, there are two. Two of them are allowed. The first one, you get the opening shareholders' equity. You add the closing shareholders' equity. You take the average. You divide it by 2. That is the most accepted one. Then the second one, you can just take the closing shareholders' equity. This is allowed. So there are 2 types. I told you, you can get the opening. What is even the opening shareholders' equity? Usually you have the preceding year and the end of this period, of this reporting period. So the closing of last year is the opening for this year. That is your opening shareholders' equity. And the closing for this year is the closing. Okay? That is the equity, the shareholders' equity for this period, for the end of this period, is the closing. The one for last year, the closing for last year, which is the beginning, which is the opening, that is your opening. So when you add opening plus closing, you divide it by 2, you have gotten the average. That is what you use for your shareholders' equity. Now, if you're not able to do that, if you don't have the information, it is only when you have the information. It is only when the company has been existing. What if it's just preparing financial statement for the first time? It will have only one financial statement, and you won't be able to get the opening because it is just its own first financial statement that you are looking at. In that case, you use only the closing shareholders' equity. So when you take the net income after tax, you divide it by the shareholders' equity, you multiply by 100, you will get a percentage, and that is what we call the ROE. What does it say? The higher, the better for you. It means that this company is able to fully make use of its equity. If you've enjoyed this class, I want us to do this again. Don't forget, we're looking at various categories of financial ratios. We have looked at liquidity ratios, and today we have looked at profitability ratios. And I told you we have the gross margin ratio. We looked at the operating margin ratio. We also looked at the net profit margin ratio. We looked at the ROA, that's the return on assets ratio. And we also looked at the return on equity ratio. Now, the essence of analyzing these financial statements is to help you make the best decisions. The accountants have prepared the financial statements. The auditors have come to express their independent opinion on the financial statements were prepared by the accountants as to whether they are true and fair or not. Now the ball is in your court as the user of the financial information generated. What do? You analyze. You analyze the financial statements, and then you make the best decision. They are not going to make decisions for you. You are the decision maker. So when you have the financial statements, you analyze and you make your decisions like a professional. I want you to I want you to share this information with someone, and I want you to subscribe to our YouTube channel. Keep watching, and don't forget, keep a date with us. We're going to bring another category of ratio analysis. Thank you.